brief introduction to Antipodes, who we are. We're a firm of 25 investment professionals, have an office, majority of the teams based here in Sydney. We also have a research office in London, and across the various strategies that we run, which is a global long only, global long short, which is the LIC vehicle, and also an Asia long short fund. The team has just over 20 million of their personal capital invested. The firm AUM is 9 billion. Now that is roughly split 60% retail, 40% wholesale. So our retail business in global equities would place us probably third in the country in terms of retail AUM. Our wholesale business is smaller than our retail business. The philosophy at Antipodes is to manage money in terms of buying in the long-short funds, looking for not just great resilient businesses, but resilient businesses that are cheap. So we talk about that as a combination of margin safety and multiple ways of winning. We, at the portfolio level, are trying to assemble a portfolio of roughly 60 longs, 20 to 40 shorts, depending on what our net exposure is at any point in time, out of what we describe as non-correlated clusters. So what does that mean? You can think about them as themes. We'll have a long theme, and it will be a group of 4 or 5 stocks that will add up to roughly 8% of the portfolio. And our shorts will often be paired against those longs. So we'll be looking to buy the cheap quality long stocks and short the lower quality expensive stocks in that area. Now, if we do that well, through the investment cycle, we think we can both deliver absolute returns and beat the benchmark. Since inception, we're 5% behind the benchmark in a market that has been going up at a fairly rapid rate. So we've delivered on an absolute return hurdle. We haven't delivered on our relative return hurdle. Our net exposure has been 60% on average. Possibly we have simply been too cautious, and that is take responsibility. It's obviously the loss to the shareholders, and you certainly, as we look forward, you have to look at the market as you see it. You have to call it as you see it. I don't think it's useful for us to anchor to the underperformance. Our net exposure today is roughly 65%. You can see in our monthly statements, in our quarterly reports, we're very transparent on what we own in both individual securities and also in currencies, by region, by sector. So portfolio performance, as you see here, over the last 12 months, we're roughly 9% behind the market. And we've broken that out by the long book, the short book, and the currencies, and then the stocks that have worked and individual stocks that haven't. The stocks that have worked have generally been in areas where you have had the beneficiaries of low rates, if you like, so the gold stocks have done well. Some of the more growthy names and the names exposed to 5G, which is a fairly hot thematic, which is Qualcomm. And some of the losers, we would argue they could break down into 2 areas. Stocks that we have called wrong, and that is in terms of our bullish view on natural gas in North America, which has not played out, simply because there hasn't been the capital rationing in a very tight credit environment. Private equity has been prepared to fund weak gas producers. We've also seen associated gas when in the shale patch in North America, in the Permian, where the shale producers have found a lot of oil, you get a lot of associated gas. And that associated gas is not sensitive to lower gas prices. Those oil companies keep producing the oil even if they're not getting any value for the gas. And so that has seen an additional source of supply that hasn't resulted in a tightening in the gas market. And then there are areas where we think we have essentially been early, and ultimately which do not represent permanent impairment of capital. In the case of EDF, in the case of Tapestry, we think these businesses that are underappreciated by the market. In terms of our observations, in terms of where we're at in the market cycle, This is a often used chart by value managers who are underperforming to justify their underperformance. What you're seeing there is basically a performance line of higher multiple stocks versus lower multiple stocks. So when the line is heading up, that means the higher multiple, or using multiple as a proxy for valuation, the higher valuation stocks are outperforming the lower valuation stocks. On this chart, I just highlight a couple of different episodes. The Nifty 50 bubble in the late 60s, early 70s, the tech bubble of 2000. It looks like a very small blimp on this chart. So what we're living through now is, I think, it's sort of unprecedented in some ways. We think it's less about the fact that investors are chasing growth and more about the fact that investors in a very low real yield environment are crowding into long duration assets. Now, what is duration? Duration is simply it's a technical term usually applied to fixed income. It just refers to how long it takes to get your starting price when you buy an asset, how many years it takes before the cash flow repays that investment. So examples are obviously very long-dated bonds. European countries like Austria are issuing 50-year government bonds at very little nominal yield, which is it's been you take even Germany, most northern European countries have been paid by investors to borrow money. So instead of having to pay a coupon, investors are paying them a coupon. So it is unusual. In equities, that has been reflected in the outperformance of growth stocks. And the interesting thing about duration is that when real yields approach zero, the discount rate that you're applying to equities means that those stocks that are on very high multiples or have growth or are leveraging their growth via debt tend to benefit the most in terms of price performance. They have the most sensitivity to those very low real yields. Now, it's just a mathematical outcome of how a DCF operates. So companies that are on low multiples, traditional value stocks, tend to lag. And that's the period that we've just been living through. When we look at the market cap of the duration beneficiaries, so defensive equities, traditional defensive sectors like REITs, infrastructure, or growth sectors like software, like life sciences, or even semiconductors, they've grown to be now the largest share of the market cap, in the history of our data. So that has been the part of the market that's been outperforming the most. When you look at it from a factor perspective, and a factor is simply a way to characterize a certain type of stock. So you can have a stock, you can look at the top quintile of one of these factors and compare the price performance of those stocks to the bottom quintile. So we look at high growth companies, high profitability companies, high momentum companies. Now, these three things, if you look at the performance of the factors since the inception of the LIC, so over the last 3 years, companies that are growing fast in a structural sense, so we're measuring that over 7 years, have outperformed low multiple stocks by almost 8% per annum. So pure alpha from owning a high multiple, like a high growth company. At the same time, the same thing has happened for companies that are offering you high profitability. Now, the pushback or the natural question would be, well, why not own those stocks? And we are ultimately looking to buy those types of companies. The problem is, if you buy that top quintile today, you are buying it at a valuation in the case of North America for growth stocks at close to a 2 standard deviation level of overvaluation. So growth is attractive if you buy it at the right multiple. And we would argue that today, those highest growth companies are probably not the bucket that you should be fishing in because they're on average expensive. Not everyone is, but the average is expensive. Same with quality. If a manager says, well, I have on average a very high quality portfolio, they are making a statement, in the case of Europe, that it's approximately a standard deviation over value. So there is an argument to own those stocks, but own them at the right price. Now, old-fashioned PE multiple has been a very tough place. Just buying low multiples has not worked. Now, we have never held that out as a successful investment strategy. We think valuation is always a combination of growth, the quality of the underlying business measured as profitability, and then the multiple that you pay. In this environment where we think there could be, an argument for a regime change or a slightly different environment going forward, is that many of the policies that have pushed investors into these very long-dated expressions of equities or fixed income are starting to lose their effectiveness. So quantitative easing, we think is generating more asset price inflation, but it's not really generating a lot of activity. Going forward, we think there's going to be a lot more discussion around fiscal stimulus. And our portfolio is really oriented towards the parts of the world that have the most dry powder. So for us, that is a combination of North Asia and Europe. In some ways, the US has used its powder pretty early. Most governments wait until you're in a recession before they stimulate, whereas the Trump administration has really gone early, at full employment. So look out for more fiscal stimulus, and I think that will change the investor preference away from duration and more towards cyclicality. The question is, how are those more cyclical parts of the market, which has been a headwind for our portfolio? We've been guilty of being too early in some of these cyclicals, and it's cost our shareholders returns. But the valuation of those cyclicals versus the defensives versus the long duration equities, you can see on this chart, the blue line is a valuation line. They are very cheap now. So now's not the time to change your portfolio construction. We think we're very happy with having a fair degree of exposure to the cyclicals. And the trade wars that have ultimately led to this manufacturing recession, we think you're starting to reach that point where there's more likely to be some sort of short-term relief around trade. Trump, the US economy, is showing vulnerability in employment in manufacturing states, and that is the Trump heartland. And I think there's increasing pressure on the US administration to see some sort of short-term truce with China. So in terms of the portfolio positioning, we show our top 10 here. It is, as you can see, many of these are household names on the long book. We are looking for companies that are, many investors may say, well, Facebook looks like a growth stock. Well, it is a growth stock, but it's not valued like a growth stock. So the PE multiple on Facebook is one of the cheapest multiples it's ever traded on. And it's growing at 30% per annum, and you're paying a PE of 20 times for 30% growth. So it's a very cheap. In an environment where investors are paying high multiples for growth, it's actually very, very cheap. Microsoft is in that same category. Stocks that are more cyclical, Siemens, we're in these stocks not because they're cyclicals. I mean, what's the point? You can buy, if cyclicals are generally cheap, let's buy the best ones. Let's buy the ones that can have a secular growth story to them. Siemens is a very simple secular growth story. It's all based around automation. As you know, demographics in most of the Western world, we have rapidly aging workforces. We have a shrinking labour force. The manufacturers need to be able to design efficiently. Product life cycles are generally becoming much shorter. So the time it takes to get from design to production needs to be very, very efficient. And Siemens facilitates that in both a software and a hardware sense. That makes it a very interesting business, trading on a PE of 13 times for something that we see as very, very resilient and with very interesting long-term growth potential. At the other end of the spectrum, something that is a little bit more defensive, that you'd put it in that defensive bucket, and as I said, they're generally expensive, Merck. So Merck has probably the best internal R&D engine of any of the large cap pharma stocks. Now, the pharma sector has been left behind because of political concerns around drug prices in the US, and we would very much avoid those companies that are gouging when they sell drugs to the US population. Merck is not in that group. Its pricing policies are very sensible, and through Keytruda, they are basically curing late-stage cancer. So it's quite an interesting blockbuster, but it's also complemented by businesses or segments that are vaccines, animal health, where you have no patent cliff risk whatsoever. So for 8% EPS growth on a sustainable basis, you're paying a PE of around 17 times. Now that compares to consumer staples where you're paying a much higher PE for a lot less growth. So we put it in that bucket of inexpensive defensives. On the overall portfolio, what we're highlighting here is how we think about the scoring of the portfolio. From a valuation perspective, our average long is in the 65th percentile in terms of PE. And that is cheap, so low. You can see the opposite in our short book. We're short on average companies that are on twice the PE of our long book. And then when it comes to the growth that we're buying for those PEs, on a lower PE, we're getting more growth in our long book, and we're also getting a much more resilient balance sheet. And that brings me to the end of the presentation, and thanks very much. And rest assured, as a team, we're very much focused on turning that performance around.